The remainder of this course is going to be broken down into 3 parts. First, we have financial literacy and reading financial statements. This is a crash course in financial accounting. This will be the subject of the next few lessons as we work our way through the income statement, balance sheet, and statement of cash flows. Later in the course, we're going to spend a few lessons drilling into management accounting, which is a more detailed look at what's going on and discusses how information is used by managers to make informed decisions to course correct. And our last couple of lessons, we'll look at the realm of finance, which is forward-looking. In finance, we are trying to predict the future so that we can make long-term decisions around investing and financing. So for now, realize that financial accounting is primarily backward-looking. So let's begin by looking back and learning from what has happened. The hallmark of your financial intelligence is being able to pick up a set of financial statements, make sense of them, ask the right questions to fill in gaps, and finally to make informed decisions. Every set of financial statements tells a story. That story is often buried in the numbers, but believe me, there's a story at play. This story has a pervasive impact on your role as an entrepreneur, executive, or director. The wrong story can cut off your necessary funding. It could demand cost containment measures, or it could cause you to sell or close one or more lines of business. A positive story, on the other hand, changes the conversation because now you can talk about making further investments or growing the business or what to do with all the excess cash that is generated from the business. Now, as you learned earlier, a set of financial statements has 3 primary components, not one statement as many non-financial people might believe. But admittedly, the statement of earnings that we're going to look at tends to get the most attention and results in the most questions. So let's walk through the statement of earnings and arm you with a few more incisive questions. Every manager is familiar with the income statement. Your role is to hold management accountable for the results presented on this statement. The trouble with financial reporting is that it often lacks giving you insight into how the business is performing, at least in an operational sense. Financial statements will, however, give you a few clues so that you can ask the right questions. But it doesn't give you that deep dive that you might find in management accounting, and we'll look at that later on in the course. The best way to describe the objective of the income statement is that it's a measure of the amount of accounting income generated during a given period. By accounting income, I mean the recognition of revenues and expenses in accordance with accounting rules. Those accounting rules are called Generally Accepted Accounting Principles, or GAAP, G-A-A-P, if you want to sound like an accountant. Not like Gap the store, GAAP, G-A-A-P. The calculation of net income using GAAP, those rules that tell you what is or is not a revenue or an expense, is not the amount of money that you've collected during the period. Remember, we have a separate statement of cash flows for that. This is probably one of the most common misconceptions, is that accounting income represents some pile of cash for that same amount, and it's almost never the case. So let's take a moment to educate you about the gap that you may have in understanding GAAP. The global standard for accounting rules is the International Financial Reporting Standards, sometimes called IFRS or IFRS. All public companies abide by these standards except for those in the United States, where there is a separate set of rules set by the Financial Accounting Standard Board, or FASB. These accounting principles, or rules in a simplistic sense, not only govern how, what, and when amounts get reported in the financial statements, but also what gets disclosed in the notes that accompany the financial statements. The accompanying notes are the longest part of the financial statements, and they often get ignored, but we're going to come back to that idea in a later lesson. But before we go on, let's recognize that not all organizations have to use these international accounting standards. For example, if we talk about a private entity in, say, Canada, there are special sets of rules, somewhat simplified principles, called the accounting standards for private entities. And many countries around the world have similar such rules, which are streamlined versions of the international standards. These standards can result in far less complexity and less disclosure. So by comparison, you might have financial statements under international standards, which are 100 pages in length, but when they use small GAAP or local standards, the pages may be 20 pages in length by comparison. Nonprofit organizations have their own set of accounting principles, which are separate from those used by for-profit entities. Government entities, guess what? They too have their own set of accounting principles. And finally, while rarer, pension plans also have a set of accounting rules, which are different than the other types of organizations. So depending on the type of organization that you're working with, recognize at the outset that there are different accounting rules at play. When it comes to the statement of earnings, generally speaking, the difference between a for-profit and non-for-profit entity is that the for-profit entity focuses on matching costs to revenues. This means that all costs associated with earning this dollar of revenue need to be expensed at the same time. That's that matching idea we talked about in our last lesson. When it comes to not-for-profit entities and government, generally speaking, it's flipped around. It's the other way around. These entities spend money and then they need to match that spending against the sources of revenue that fund those expenditures. When funds are raised with a specific purpose in mind, they do not get recognized as revenue until that specific purpose and the associated spending has been incurred. So for example, consider a church that raises money to repair its steeple. The fundraising revenues are only reported as revenue once the church spends the money to do the steeple repairs. Other sources of revenue, say the weekly collections, are for an unspecified or non-restricted purpose. These are recognized as revenues as they are collected, and they're generally available to offset ongoing operating expenses. As we go through the remainder of the course today, we will reference financial statements from for-profit entities. The principles of financial intelligence apply broadly, however, and so you really need to consider the nature of the organizational context to determine the appropriate accounting rules that apply. So, let's now work through the income statement.